This is DC Bar's Brief Encounters, a series of podcasts brought to you by the DC Bar. I'm Don Resnikoff of the DC Bar's antitrust and consumer law community. Today's guest is Art Wilmarth, a respected expert on financial regulation who has written and spoken broadly. I'll provide a citation to his recent book and most recent articles in the written introductory material. Art is going to talk today about the problems of lax regulation of cryptocurrency generally and so-called stablecoins in particular. He will focus on issues concerning the so-called Genius Act, which is now making its way through Congress. Because Art's comments have great practical importance as well as scholarly weight, I want to give away the punchline of his comments even before he speaks. And I do that because I want listeners to stay with us and not be deterred by the inevitable complexity that comes with a discussion of cryptocurrency. The punchline is that lax regulation of cryptocurrency in general and of stablecoins in particular can threaten the stability of our financial system. One worrying scenario is a meltdown of our financial system like the one that occurred in the period 2007 to 2009, when the Fed was forced to expend great amounts of taxpayer money to bail out banks and bank-like companies that had made risky and unsuccessful investments in mortgage-backed securities. Art's concern, we'll see, is that we can repeat that history and worse, with risky asset next time being cryptocurrency. But now let me turn to Art so he can explain, and I'll ask Art this question. Art, the congressional proposal called the Genius Act concerns the regulatory treatment of the form of cryptocurrency known as stablecoins. What are stablecoins?
So stablecoins are digital assets, they're crypto assets. They differ from the largest cryptocurrencies such as Bitcoin and Ethereum, which have wildly fluctuating values, no fixed value. Stablecoins at least tell investors that they will try to maintain a stable value almost always linked to the US dollar. About 98% of stablecoins are linked to the US dollar, because the issuer will maintain financial reserves, again, supposedly sufficient to maintain that parity with the US dollar.
And how are stablecoins used?
So currently, stablecoins are really used primarily for two things. One is mainly to speculate and trade in other cryptocurrencies, such as Bitcoin and Ethereum. If you want to trade in cryptocurrencies and you're going to a crypto exchange, generally they will require you, or at least want you, to convert your cash, US dollars, into stable coins, use those stable coins essentially as poker chips at the casino. And then when you're ready to collect your winnings or reconcile your losses, then you have to convert your stable coins back into cash and leave. Or, of course, you can leave your stable coins at the exchange as long as you want. But essentially, they're primarily used as poker chips at the crypto casino. Unfortunately, there's a second significant use of them, which is for a wide variety of criminal activities: ransomware, cyber fraud, sanctions avoidance, money laundering, drug and sex trafficking, because people have discovered that if you use stable coins in a private digital wallet, and you also use other things called crypto mixers, you can conceal your identity in quite a satisfactory way for criminals. It's not absolute, but there's definitely a cloaking function. In contrast, if you use money out of your bank account, that's very easy to trace. And in fact, the government does trace that, and they require banks to tell them about large transfers of money. So stablecoins are an attempt, in a sense, to stay in the shadows and conduct these nefarious activities.
Thank you. Now, in your recent George Washington University Law Review article, you explain that recent runs on stablecoins resemble the runs that occurred on uninsured short-term financial claims during the U.S. financial crises of the past, such as the 2007 and 9 to 9 crisis. Could you say more about that?
Yes, I mean, our whole financial history demonstrates that when either banks or non-banks issue deposit-like claims, which are essentially they take your money and they promise to return it either on demand or within a fairly short period of time at par, which means 100% of what you gave them, they give back, plus perhaps some interest, or to transfer that money again at 100% of par value to other people. When banks or non-banks offer those types of claims, the holders of those claims are very concerned about maintaining that 100% of their money. And if they have any reason to think that they won't get 100% back, they will run. They will yank their money out as fast as they can because they realize that in a bank run, the first people out get 100%. The last people out maybe get much less than 100%. And stablecoins effectively are bank deposits because, again, they're telling you, you give us your money, we will give you back your money at 100% of what you gave us, maybe with some interest, depends on where you get the stable coins, or we will transfer your stable coins to somebody else, again at 100% of what you put in. So once again, if stablecoin holders think that the issuer is not going to be able to cover claims at 100%, they're going to yank their money out. And we've already had several stablecoin runs, some which have completely destroyed stablecoins, others which have temporarily disrupted them. We saw it with money market funds in both 2008 and 2020 when people were concerned that they couldn't get back necessarily 100% of their money market funds. There were major runs on money market funds and they had to be bailed out by the government. So what has happened since 1933 with the Federal Deposit Insurance Act is that the federal government has essentially protected 100% of depositors. Not always, not completely, but particularly in recent years, almost always. Since the 2008 crisis, there have been a tiny number of very small banks that have failed without getting 100% depositor protection. In banks of any size, we saw this in 2023, 100% of deposits have been protected. Well, this is what stablecoin holders are going to expect. They're going to expect the federal government to do that. And if there's any doubt about it, there are going to be devastating runs on stablecoins when there are concerns about their repayment.
So we see that there are certainly lessons to be learned from the financial crises of the past, including the 2008 crisis. And my next question to you would be, do you think that the Genius Act, now working its way through Congress, is sufficiently responsive to those lessons?
No, it's a very weak and inadequate statute. It's a very bad bill. I encourage everyone listening to this broadcast to encourage your members of Congress to vote against the Genius Act. And there's also a companion bill called the Stable Act. I mean, which is again a very ironic title for stable coins that are going to be very unstable and very vulnerable to runs. But they call it the Stable Act. Same thing. It's just as bad a bill in the House as the Genius Act. We can discuss the details, but essentially there are inadequate capital requirements, inadequate liquidity requirements, inadequate examination and supervisory enforcement requirements. But the main problem is there's no federal deposit insurance for these stable coins in either bill. There's no federal guarantee. There's no federal support. So they contemplate that a stablecoin issuer that goes bust will go into bankruptcy. And we know that when Lehman Brothers went into bankruptcy in September 2008 because the government refused to rescue it, that was what set off the worst part of the financial crisis because people thought if Lehman Brothers is going to go into bankruptcy and there are going to be big losses, then we don't know where this is going to stop. Lehman Brothers had over $600 billion of assets, and people absolutely panicked. And there was a general run on almost every short-term claim in the financial markets. So when the next crisis comes, there's going to be no FDIC, there's going to be no Federal Reserve, and so there's going to be panic. And the federal government will either have to decide that they will step in and bail out stablecoins with some kind of ad hoc emergency bailout, or they're going to risk a panic that will spread into the rest of the financial markets. So the idea that we're now creating a new category of uninsured non-bank deposits. This has been a recipe for disaster repeatedly in the past. Shadow deposits are a very bad idea. They're always lead to problems. And so it's going to lead to another problem if we allow this to happen.
Well, we'll talk more, of course, about the Genius Act, but let me interject a question from your George Washington University article. In that article, you talk about the claim of advocates for stablecoins that stablecoins will greatly improve our payment system and increase financial inclusion, including such things as the unbanked, giving them some access. Could you comment on that?
In my view, misleading claims being made about how stablecoins will be sort of the nirvana of the payment system, and it will modernize the payment system and make it so much better and faster. In fact, there's no basis for that. Non-bank stablecoins operate on public blockchains, a number of them on Ethereum, some on Solana, other blockchains. Public blockchains simply cannot process large numbers of transactions quickly and efficiently and reliably, because public blockchains have very complicated and drawn out, difficult processes for validating transactions. And so there's what we would call a scalability problem. You can't push large numbers of transactions quickly through these public blockchains without getting them gummed up and encountering all kinds of delays and problems. This is very different from the way banks conduct business, because the banks control their ledgers, or Visa and MasterCard control their ledgers for transfers, and they because they have sole control over the ledgers, they can process payments very rapidly. The other problem, and I think it's even a more fundamental problem with public blockchains, is once a transaction is finished, is recorded, it's virtually impossible to reverse. In fact, they call that immutability. In other words, irreversibility. So if you have a stablecoin transaction that is mistaken, fraudulent, or unauthorized, once it's recorded, it's done. You're not going to be able to unwind it. That is completely different from what happens when you use your bank debit card or bank credit card. With your bank debit card, which comes out of your bank deposit account, you absolutely have the right to challenge fraudulent, mistaken, or unauthorized transactions. With a credit card payment, you actually have more rights. And so if you do a credit card transaction and you say that the seller of goods or services did not perform as promised, did not give you what they promised to give you, you can dispute that transaction and in many cases reverse it. There will be you have no such right with stablecoin payments. So to me, a person would be very ill-advised to use stablecoins for general payments as opposed to using a bank debit card or a bank credit card. So I think that it's not at all a workable solution to improving our payment system. In terms of financial inclusion, the crypto industry has had a terrible track record. They encourage people to buy very risky, very speculative cryptocurrencies, promising them that they would build great wealth. And then we saw during the crypto winter, the crypto crash of 2022, we saw that people lost, all or most of their investments. The losses were particularly large among many minority communities who had been misled into thinking, oh, this is a better way to build wealth than the traditional financial system. And so many people, including myself, have said the crypto industry has essentially been predatory and exploitive toward underserved communities. It has not had any record of meeting their needs. The last thing I would say is stablecoins, you can't get stablecoins unless you already have a bank account. So you can convert your dollars from your bank account into stablecoins and back again. So if you're unbanked, stablecoins won't help you.
Thanks very much. Let's go back to the ongoing actions in Congress, and I'll ask you, do you have other suggestions for Congress to remove the dangers posed by uninsured non-bank stablecoins?
Yes, so I think there's a very simple answer, which is, as I said before, stablecoins are functionally equivalent to deposits. Therefore, they should be regulated as bank deposits. And we have learned over our long history, and it's really why we passed the Federal Deposit Insurance Act in the first place, that deposits are not safe unless they are covered by federal deposit insurance and are in FDIC-insured banks that are very carefully regulated, have a number of important public duties and public responsibilities, and they're very carefully supervised. That's the trade-off you make. If you want to be a bank, you have to be carefully examined and supervised, and then of course you're protected by the federal safety net. So we're making a terrible mistake to create a parallel banking system that is not well regulated, not insured, not supervised properly, and will be bailed out during a future crisis, but we're just asking for trouble. So the way to resolve that is to say, no, if you want to issue stable coins or deposits, you have to be an FDIC insured bank. Now, I do think that there are good proposals for improving both our payment system and financial inclusion. And for example, the so-called Bank On program has encouraged banks and has been very successful in promoting greater access to low-cost, reasonably priced deposit accounts with payment services for lower income households. And it's made good headway. I do think that Congress should say that because the ability to take deposits is such a public privilege and public license and is so carefully regulated that FDIC insured banks should have an obligation to provide low-cost deposit accounts with reasonable fees and payment services to all households who meet minimum qualifications for legal status and financial responsibility. So there should be what I would call a qualified universal service requirement so that everyone can have access to a good, safe FDIC insured bank account. They don't have to go to check cashers. They don't have to go to payday lenders. I think that should be part of future legislation.
Thank you. As we come toward the end of our discussion today, I do want you to focus a bit on antitrust concerns. And I'm thinking particularly of your point that the Genius Act would allow big tech firms and other commercial enterprises to acquire non-bank stablecoin issuers and use stablecoins to enter the banking business and build large financial empires. Would you comment on that, please?
Yes, that's a huge problem with the bill. We have, in this country, we have a tradition of separating banking and commerce. So at the moment, big tech firms, can't get into the banking business. If we allow for uninsured non-bank stablecoins, I am absolutely confident that every big tech firm will use stablecoins to get into the banking business. We know that Meta, Facebook already has plans underway. They tried before to do this and were dissuaded by regulators, but they're ready to go forward. Certainly, Elon Musk has said that X plans to offer a stablecoin if this legislation goes forward. I'm sure that Alphabet, Google, and Apple, and Amazon, and the others, Microsoft, will follow suit. And then we would have what I would call giant banking and commercial conglomerates that would be financial institutions of a size we've never seen before. These would be immense organizations. They would have financial surveillance over every aspect of your life. They would not only know your personal shopping patterns, your personal travel patterns, they would know everything about your financial assets. This would give them unbelievable power and surveillance, which they should not have. It would give them far too much economic, financial power and political influence. So we must stop big tech from getting into banking, and this bill will absolutely open the door to that.
Thank you. And then before we conclude, we do have a little bit of time left where if you have other concerns about the Genius Act that you can share with us, this would be the moment to do that.
Yes. So one of the worst aspects of the bill is that it would allow stablecoin issuers not only to issue stablecoins and distribute them, sell them, but to engage in any other activities permitted by their federal or state regulators. Well, we know that stablecoin issuers will want to issue crypto derivatives. So we already have options, futures, exchange-traded funds, exchange-traded products, all sorts of derivatives are already appearing based on Bitcoin, Ethereum, other cryptocurrencies. This will proliferate, and derivatives are incredibly dangerous. So you mentioned the financial crisis of 2007 through 2009. One of the major causes of that crisis was that you didn't simply have these subprime mortgages that were made to people who couldn't pay them back. They were made on inadequate collateral because the homes had been greatly overvalued in the appraisals. So the mortgages were essentially unsustainable and exploding mortgages. But then you had a whole series of bets on top. You had, of course, as you mentioned, subprime mortgage-backed securities. They were packaged into securities and sold to investors. You had collateralized debt obligations. You had synthetic collateralized debt obligations. You had credit default swaps. So you had a whole series of derivative bets piled on top of these subprime mortgages. So when the subprime mortgages failed, and there were about 2.7 trillion of them, it wasn't just that failed. It was the whole pile of bets on top of it, and the whole pyramid of debts collapsed. Imagine if we did that with crypto. So right now there are about 3.1 or 3.2 trillion of cryptocurrencies with fluctuating values out there, like Bitcoin and Ethereum. Imagine if you piled trillions of dollars of additional derivative bets on top of those, and these crypto assets have actually no underlying values at all. In other words, there are no homes, there are no real world assets other than a tiny, tiny amount, maybe 20 billion, as opposed to 3.2 trillion. There are no underlying assets. It's all thin air. They're only worth what somebody else will pay for them. So if suddenly people lose confidence in these assets and they go down in value, all the bets piled on top of them will collapse along with them. And we'll have this cascade that we had in 2007 through 9. So allowing people to write crypto derivatives and offer stablecoins either separately or in combination is just a recipe for disaster.
So to summarize your advocacy and bring this discussion to a close for today, the gist seems to be that without a well-regulated banking system, there really can be a real threat to the financial stability of the economy, and that the Genius Act actually moves us in that direction, in your opinion. And
yes, and the final thing I would say is that we have a development called tokenized bank deposits, which essentially is turning deposits into digital records, much like we turned checks into electronic checks. We're turning traditional deposits records into digital records. So these tokenized deposits are being placed on electronic distributed ledgers controlled by the banks, and that improves record keeping and improves the speed of transactions. But those are all carefully controlled within the FDIC-insured banking system. So we're modernizing the payment system within the banking system that is well regulated. There is no reason to create this sort of jury-rigged Swiss cheese construct outside the banking system. There's no reason to do it other, again, than to reward the speculators and unfortunately facilitate criminal activity. So I would say normally with legislation, you would say, well, there's some good and there's some not so good. With the Genius Act, I do not see any single argument that is persuasive regarding any benefits, and I see enormous downsides, enormous risks, enormous problems. This is one of the worst bills I have seen in a very long time. And again, I urge people, contact your members of Congress, tell them they must not pass this bill. This sets the stage for another horrific financial crisis, which we certainly cannot afford given our current fiscal and debt situation.
well, this is an aspect of a debate which I think is very important that it be brought to the attention of the general public, and hopefully this podcast can help do that. And I thank you very much, Art, for your talking to us today.
Thank you very much, Don. I appreciate it.